Welcome to Iron Financial. Look, our mission here is absolutely simple. We are here to help you forge a stronger, more resilient portfolio. And today's explainer is entirely dedicated to cutting through a massive, honestly bewildering market contradiction that we just witnessed. We're looking at a company that literally just crushed its earnings estimates. Delivered absolutely record-breaking top-line numbers across the board. And yet, the second the market opened, its stock plummeted nearly 9%.
It's exactly the kind of price action that drives retail investors absolutely crazy, right? You wake up, you check your phone, you see the headlines flashing green with a massive earnings beat, but then your portfolio is just flashing red. There's a total disconnect. We are, of course, talking about SoFi Technologies and their Q1 2026 earnings report. So today, we are putting this stock right on the anvil. We're going to strike it hard and see what it's genuinely made of.
Let's just dive right into this and ask the burning question that literally every single SoFi shareholder is agonizing over right now. Why on earth does a record billion-dollar revenue beat trigger an immediate 9% plunge in the stock price? Is this just some temporary market weakness, a quick shakeout of the weak hands before a rally? Or, and this is the scary part, are we looking at a fatal crack in the foundation of the company?
That is exactly what we need to stress test today. Listen, to understand if SoFi is structurally sound, we have to look way past the flashy fintech headlines. We cannot just look at their slick app interface or their marketing campaigns. We need to look at the heavy lifting mechanics of their financials. And to do that properly, we first need to establish a baseline. We need to know what a durable, stress-tested banking foundation actually looks like, right now, in today's severe macroeconomic environment.
Section 1. A solid regional foundation. Before we dissect SoFi's billion-dollar facade, we need a traditional heavy-duty benchmark to measure it against.
Think about it like this. If you're going to build a skyscraper, you don't start by analyzing the shiny glass windows, right? You look at the concrete, you look at the rebar. Regions Financial represents that traditional concrete and rebar of the financial sector. Now, look specifically at the return on average tangible common equity, or ROATCE. It's coming in at a highly robust 18.26% for Q1 2026. Let's go into detail on why the specific metric matters so much. ROATCE is basically the absolute gold standard for measuring pure operational efficiency. Why? Because it strips out all the accounting fluff, the goodwill, the intangible assets. It tells you exactly how much cold hard cash a bank is generating from the actual tangible capital that shareholders have given them. Pulling an 18.26% return in a high interest rate environment where funding costs are just squeezing everyone is a testament to ironclad discipline.
And you have to add their efficiency ratio of 56.6% to that picture. Now, in traditional banking, a lower efficiency ratio means you're spending less overhead to generate each dollar of pure revenue. So 56.6% means this is a lean, structurally sound operation. They aren't just burning through capital on excessive marketing or some bloated tech budgets just to keep the lights on. They're generating consistent, sustainable, long-term performance without all the hype. This right here is the baseline of durability that any challenger bank, and yes, that includes SoFi, eventually has to prove they can match if they want a stable, long-term valuation.
And this brilliantly illustrates the bottom line of that traditional approach. Regions posted a rock-solid $539 million in net income available to common shareholders. But honestly, the number that really jumps out to me as the skeptic is their net charge-offs as a percentage of average loans. It sits at a mere 0.54%. Let's really frame that for a second. We're operating in an environment where everyday consumers are highly pressured by inflation, they're pressured by elevated borrowing costs, and yet Regions is experiencing barely over 0.5% in default losses.
Exactly. Barely 0.5% of their loans are going bad. That is an ironclad credit portfolio built on rigorous, totally uncompromising underwriting standards. They are managing risk impeccably. So I want you to keep these foundational numbers locked in your head right now. 18.26% tangible returns, a 56% efficiency ratio, and 0.5% in loan losses. Because now we're going to contrast this heavy-duty, traditional banking performance with the flashy, high-growth world of SoFi's latest earnings. Let's see if the challenger's foundation is actually built on rock or if it's just sitting on sand.
Section 2. SoFi's billion-dollar facade. Let's aggressively pivot over to the challenger bank's numbers and unpack this absolutely massive volume of data they just dropped.
Okay, so on the surface, the top-line numbers look absolutely bulletproof. Seriously, if you just read the press release highlights, you would think this company is an unstoppable juggernaut, forging ahead without any resistance whatsoever. But remember, Wall Street doesn't pay you for yesterday's headlines. Institutional money is busy pricing in tomorrow's reality. However, we absolutely must acknowledge the sheer objective scale of the beats they posted here.
These are the headline-grabbing metrics that had retail investors cheering right before the opening bell. Just look at this growth engine. Total members hit 14.7 million. That is a 35% year-over-year increase. They added a record 1.1 million new members in just this single 90-day quarter alone. To put that into perspective, traditional regional banks take years, sometimes literally decades, to acquire 1 million highly engaged users. Furthermore, total products soared to 22.2 million, up 39%. This effectively proves their financial services productivity loop is actually working. They bring you in for a student loan or maybe a checking account, and then they successfully cross-sell you a personal loan or an investment account.
Right, and the sheer volume of the originations. Total loan originations hit a staggering $12.2 billion. Plus, they delivered a record GAAP net revenue of $1.1 billion for the quarter, which represents a 43% increase year over year. By literally all traditional retail growth metrics, this is a massive blowout. They aren't just growing, they are compounding their top-line scale at a velocity that traditional banks simply cannot organically match. So, the crucial point is this. CEO Anthony Noto comes out and confidently boasts, our one-stop shop is scaling exactly as intended and delivering a winning combination of growth and returns. And they did just hit their 10th consecutive quarter of GAAP profitability. Adjusted EBITDA was $340 million, up an explosive 62%. So here is the multi-million-dollar question. If the business is scaling flawlessly, if they are printing their first billion-dollar revenue quarters, and if bottom-line profitability is compounding by over 60%, why in the world did institutional money ruthlessly dump the stock by 9%? Why did the market punish them so severely the second the opening bell rang? Well, to answer that, we have to move past the top-line cheerleading and start looking for the structural weaknesses hiding deep in the foundation. Section 3, Finding Cracks in the Armor. This is exactly where we earn our keep at Iron Financial. Let's move straight into the actual trading mechanics. Wall Street is ruthless. They literally do not care how beautiful the building looks from the outside if the underlying support beams are starting to show early signs of stress. So let's dive into a concept that is absolutely critical to understanding institutional market reactions. It's called the published consensus versus the whisper number. The published consensus for SoFi's Q1 was an earnings per share, or EPS, of 12 cents. SoFi reported exactly 12 cents. They met it. Check the box. But here is the massive trap retail investors fall into all the time. Beating or meeting the published consensus means absolutely nothing to algorithmic and institutional investors if you don't beat the shadow metric.
Exactly. The whisper number is what hedge funds, buy-side analysts, and massive institutional money actually expect the company to deliver, and it operates entirely outside the officially published estimates. Because SoFi beat their EPS by almost 18% last quarter, psychologically and algorithmically, the bar went up. Wall Street analysts have access to alternative data, they do credit card scraping, they do real-time app download tracking. They were quietly expecting, or whispering, that SoFi's run rate would push them to hit 13 or even 14 cents this quarter. But they only hit 12. So, in the eyes of the smart money that commands billions in capital, SoFi didn't meet expectations at all. They materially disappointed.
But honestly, the whisper number miss isn't even the fatal flaw here. The real structural damage is sitting right here in their forward guidance. Management projected full-year 2026 adjusted net revenue of $4.655 billion. And this brilliantly illustrates the severe disconnect between retail optimism and institutional reality. The street, meaning the analysts actually modeling the future cash flows, were expecting a full-year guide of $4.749 billion. SoFi's own management is guiding nearly $100 million lower than what the market modeled. Furthermore, their Q2 revenue growth guidance suggests a sudden slowdown to 30%. That's down significantly from the 41% pace we literally just saw in Q1. Listen, when a hyper-growth tech stock signals a fundamental deceleration in top-line growth, algorithms trigger sell programs instantly. The market aggressively forces what's called a valuation multiple compression. They basically strip away the premium tech multiple and start pricing it like a standard slower growth financial firm. That is exactly why the stock cratered. So moving forward, how do we know if the foundation will hold or if it's going to buckle? We've isolated 3 fundamental metrics required to evaluate SoFi's structural integrity over the next 2 to 3 quarters. First is the net interest margin, or NIM. In Q4, SoFi's NIM was a very healthy 5.72%. It must absolutely hold above 5.6%. If it contracts below that, it means their cost of funding is rising way faster than the yield they are generating on loans, meaning their core profitability engine is severely constrained by sticky inflation.
Right, and I'll take number 2, fee-based revenue growth. In the previous quarter, their non-lending fee revenue grew an impressive 53% to $443 million. This fee revenue is what makes them a fintech in the eyes of investors. But if fee revenue growth decelerates below 40% year over year, the entire narrative shifts. SoFi stops being valued as a high multiple diversified technology platform and gets dragged forcefully back down to being valued as a traditional, low multiple, capital-intensive lending company.
And number three, well, number three is the most dangerous crack of all. We're talking about personal loan charge-off rates, and this ties directly into the heaviest threat facing the company right now. Market skeptic. Section 4, the muddy waters threat. You cannot forge a strong portfolio by just ignoring the bears. We have to force the conversation toward the absolute darkest cloud hanging over the stock right now. It is the aggressive short seller report for Muddy Waters. You have to look at their thesis, you have to stress test it against the core data, and decide if they are finding real rot in the wood or if they're just making noise to drive the price down. Look at the sheer volume of unsecured debt in these originations. In Q1 2026, SoFi pushed out $8.3 billion in personal loan originations. Remember, unsecured debt means there is zero collateral. If a borrower defaults, SoFi cannot repossess a house or a car to recover the capital. It is just pure loss.
And here is the glaring vulnerability. While we saw Regions Financial holding an ironclad charge-off rate of 0.54% earlier, SoFi's personal loan annualized charge-off rate recently sat at an elevated 2.8%. Now, SoFi's management continues to claim their stringent underwriting supports a maximum cumulative net loss assumption of 7 to 8% for the life of these personal loans. But if we hit a true macroeconomic recession, those unsecured loans are literally the very first obligations consumers will stop paying. That rising personal loan charge-off rate is the most dangerous crack in SoFi's foundation.
Because if those charge-offs rise, it gives massive, undeniable credibility to the Muddy Waters short seller allegations listed right here. The bears allege SoFi has $312 million in unrecorded JP Morgan debt that is artificially hidden off the balance sheet. They claim SoFi's reported adjusted EBITDA is actually inflated by nearly 90% due to shady accounting maneuvers. Let's really go into detail on that last point: irregularities in revenue recognition. In the fintech space, companies often recognize revenue by valuing the loans they hold on their balance sheet at a premium based on future expected yield. It's called mark-to-market accounting. Muddy Waters is essentially claiming SoFi is marking these unsecured personal loans to absolute fantasy valuations. If those 2.8% charge-offs start rising, the actual value of those loans collapses entirely. That forces massive write-downs that would completely wipe out their highly celebrated EBITDA. And notice what management hasn't done yet. They haven't directly, aggressively dismantled these specific accounting claims step by step on the earnings calls. That silence is absolutely deafening to institutional investors. If that personal loan charge-off rate spikes above 3.1% in the upcoming quarters, these allegations of inflated profitability won't just be a short seller's conspiracy theory anymore. They will become a fundamental reality. The market is aggressively pricing in that exact risk right now. Section 5. Verdict. Opportunity or trap. We've stress-tested the foundation. Now let's weigh the heavy iron. It's time for the final no-nonsense ruling from us at Iron Financial. Let's move to the scales and rapidly build this out. On one side, you have the undeniable sheer force of the bull case, record compounding top-line growth.
But on the bear side, you have downward earnings revisions and fundamentally slowing forward guidance.
The bulls point to a massive footprint. We're talking 14.7 million members and 22.2 million distinct products successfully cross-sold.
The bears point to institutional disappointment. They entirely miss the institutional whisper number, triggering algorithmic sell-offs.
The bulls hold up the ultimate shield, 10 consecutive quarters of genuine GAAP profitability.
But the bears drop the hammer, looming credit deterioration risks tied to $8.3 billion in unsecured personal loans, severely compounded by a vicious, highly detailed short seller report attacking their revenue recognition. The foundation is under immense, multifaceted pressure from Wall Street.
And this brings us to the ultimate decision you have to make for your portfolio. We've shown you the benchmark of traditional stability with Regions Financial, and we've exposed the aggressive, high-risk, high-reward architecture of SoFi Technologies. We've dug way past the PR press release and shown you the actual structural cracks that the algorithms are aggressively trading on. So, what is your verdict? Looking at all this heavy data, is SoFi's billion-dollar facade a genuine opportunity to forge long-term wealth at a steep discount? Or is this a structurally compromised value trap just waiting to collapse under the crushing weight of market stress testing? Let us know where you stand. Until next time, keep your fundamentals strong, ignore the noise, and keep your portfolio ironclad.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.